The US only has 25 days left of glitter? Who cares? How many DT are you planning on for tonight? 3 to 5? I already bought into my straddle for tomorrow. I have November 14s, which are what? Those are like 5 DT, right? Yeah. You don't think this is the bottom for GME this week? It could be. They could also short it harder. If the market rises tomorrow morning, they're going to need to use all of their short leverage and all of their internalization to suppress the price, right? They're not going to be able to actively short it more. If the market drops tomorrow, then they're going to short it a lot fucking harder. Yeah, the de-risking is general. Well, primes are de-risking short sellers. No, no, I mean, like, the effect on crypto would be like institutions that are holding crypto selling crypto off in order to get liquid cash. Could this be the short's last gasp, holding out for CPI crashing the market? I think so, because something really interesting that we've seen over the last, well, something I've noticed over the last few days, I've brought it up a couple times, is that the time horizon on short positions on SPX since the end of the pimento, right? So since October 21st, the time horizons have been drawing in closer and closer. Um, so we were seeing after October 21st, we were seeing like like 14 DTE, 7 DTE, 7 to like 14 DTE positions, right, on the short side, and then we were seeing like 5 to 10 DTE, right? And now we're seeing like 1 and 2 DTE. And this has happened really, really rapidly. Is that like the leverage short side is increasing in value, but it's decreasing in theta, right? Um, and so, I mean, this is a really good sign that short positions are slipping, right? And if you guys remember Bobby, this is something that we discussed on Bobby when they rolled forward their put wall, right? Bobby started pushing up against them, and we saw them roll their put wall forward, and then we saw them roll it forward again. And each time they rolled it forward, the amount of puts drastically increased, but the length of time to expiration decreased, right? And so over time that put wall went from very big to smaller to much smaller, and then it capitulated, and that's when Bobby ran, right? And we're seeing a similar effect where we had this massive short position on going into the October expiration, right at the end of the pimento. We're now seeing a similar effect where short positions over time are losing their grip on shorting the indices, right? And they're clearly holding out for the next major macroeconomic event, which would be here at CPI. If CPI is positive, or well, if the print is negative, but the sentiment would be positive from that, or even right. So like our last print was 6.6, which was actually extremely bullish because the previous print was positive zero point 0.4. This 6.6 print was positive zero point 0.3, right? And so that shows a decrease in the rate of acceleration. And so if we see zero point 0.2 positive or better, which would be, zero point 0.1 or 0 or -1, right? These would be the better values. Then that could mean even more bullishness, right? And I think shorts are afraid of that, right? That outcome tomorrow would be very bad for them because this outcome increases the likelihood of a Fed pivot. It increases the likelihood of a lower rate increase in December, or maybe no rate increase at all, right? And now all of a sudden you're fighting against not only the market conditions which are making shorts really unfavorable, and the lack of liquidity in their cash positions, and the VIX overpricing puts and making it really difficult to gain any meaningful leverage. On top of fighting all of that, they'd also be fighting bull positions coming in leveraged, right? I mean, it's not like primes don't know that if they're going to call the risk on billions in short sales, that they're not going to, like, position to capture the upside move, right? Like if you lend out, say you own 1,000,000 shares of a stock with a 10 million share float, right? So the company's got a 10 million share float, and you own 1,000,000 shares of their stock, right? And all these shares have been borrowed, right? They've been lent out to short sellers, and the price of the stock, has gone up, and then you lent out shares, and shorts brought it down. But you know that in the future, the price of this stock is going to go much lower, right? So your projections, your analysis on this stock says that this stock is going to lose 50% of its value in the next 6 months, right? Well, you don't want that, right? Because even though you're lending out your shares, you still own 1,000,000 shares of this fucking company, right? So what do, right? Well, first you would buy calls because the price is low, right? And you buy a bunch of calls, and then what you do is you recall your shares, and you're recalling 10% of the float of this company. It's a huge move, right? So you recall your shares, and that forces the short seller in T+2, or however long you give them. You can technically force close them immediately to buy the underlying stock at its current price. And that's going to drive price up into your calls, which then the market maker is going to accelerate price action upwards, right? And you can close out your calls and then sell your shares. And then the stock can drop 50%. And primes do this, except the entire fucking market, because they own 10% of everything. And they lend it all out to short sellers as much as they feasibly can.